Today, we've got a special guest with us. We've got Samuel Waxman joining us from Sterling Park. Really excited to talk through some of the items that I think are a little less common or top of mind for business owners. So thank you, Samuel, for joining us.
Thanks, Jim. Happy to be here. Excited to chat.
Yeah, appreciate you taking the time on a beautiful Friday morning.
Right?
Realize you could be riding your bike or going out for a run. So it's
Yeah, I must really like you for chatting now.
So a little bit about Samuel. Realized, we both studied at Western, which was nice. He's been in the field for about 10 years. Joined Sterling Park. He's got some great specializations. Can you tell us a little bit about yourself and the sort of clients you work with?
Yeah, absolutely. So a little about myself. I've been in business 10 years. I initially got in the business as a next generation. My father brought me in the business. And the idea was to slowly take over his practice and work with his clients. Did that for a couple of years and then realized I wanted to kind of do my own thing, which is where I did. Did that for a few years, things were going well, slowly built up my client base. And in doing so, I realized that that younger generation, the millennial generation, the next generation, really was going to be in the need for insurance planning very soon and didn't necessarily want to go to their parents' person who may be in Florida half the year, pre-COVID, obviously, or even on the golf course a lot of the time, and wanted somebody who can relate to them, would do things at their speed, would do things at their methods. And that's when I realized that that's who I really want to be speaking to. That moved me very forward into the young professional market. So working with a lot of optometrists, veterinarians, other medical practitioners, and really just helping them realize the need for insurance fresh out of school and where those needs consistently change over time as you grow. And I think where I try to distinguish myself is because I'm young, because I'm their age, I'm going to grow with them. So it's not like I'm going to push a product on you today. You're going to buy this because it makes sense, and I'm never going to talk to you ever again. No. Here's what we're going to talk about today, because this is what makes sense for your personal situation. It's not product, it's planning based. And as times change, both of our lives are going to change, and we're going to grow together where those needs will constantly change. That led me to Sterling Park in 2019. I'll touch a little bit more on Sterling Park afterwards. But as a firm, we really focus on the analysis and the planning. And joining the group there really has allowed me to excel in my career, realize the need for doing proper needs-based planning and specializing with all different markets and all different types of individuals to make sure that everyone's getting the proper service, no matter who you are, where you're from, or what your situation is. And yeah, that's really the gist of me and how I got here 10 years later. It happens very quickly, Jim.
Yeah, I realize that. No, and has COVID affected the way you do business and the way things are done today versus pre-COVID? Or
so personally, a big chunk of it is no. I've always been very tech enabled, tech forward. I try to make myself as tech forward as possible. So I was using a lot of these methods pre-COVID. What COVID has allowed to happen is it's allowed the industry to move forward and to catch up to me. So I find that my industry, while it's great and we do a great service at the end of the day, it's a very prehistoric industry. And COVID's allowed us to move from like 1965 to like 1995 right now. So we're like just entering the internet era, hoping we can get to current times pretty soon. But what I find COVID has done is it's made people realize, okay, well, now they have a little bit of time on their hands. So it's time to start doing all this planning stuff that was pushed to the back burner a lot. Now it's time to say, okay, I have no more excuses. It's time to get it done. I've realized that I need to do it. As a firm, we don't believe in scare tactic planning. And while that was happening a lot in the beginning of COVID, people kind of talking about, well, insurance is needed now. Look what's going on in the world. We don't believe in that. We took a step back at the time. But I think what COVID, as I kind of said, has allowed people to do is realize, okay, well, insurance is something I should be thinking about. I have time in my hands. Things are okay now. Let me get this done and do the proper planning so I never have to have any worries, because you never know what happens in the world.
Fair enough. No, I've heard that numerous times, your point about, the industry is slowly moving forward with technology. So hopefully you're close to, the 2000s where I'm currently sitting. So if you can nudge me forward too at the same time, that'd be great. So let's talk about the agenda today. And I'm interested to hear a little bit more about Sterling Park and what makes you guys unique as well.
Yeah. So further to myself, I think it's worth mentioning who Sterling Park is, the work we do, why we do it, and how we do it. And then the topic being the shareholders agreements, why they're important, problems that arise, how we can fix them, buy-sell clauses being the main reason how we fix the issue that we're going to talk about, and just really explaining its importance, its implementation, and structuring. So a little bit about Sterling Park, 50 years of collective insurance experience. We're a firm of 3 advisors, 1 tax and estate lawyer, and then we have a bunch of support staff, including an underwriting consultant, as well as other support administrators. Where we find we're different is we're not just every insurance firm that has a few insurance guys going out talking products, saying you need this because of this, you fit in this box, so this is what you're going to get. We're very big on the estate planning, on the needs planning, the facts-based planning. And where that fits in is to who we are as people. So as a firm, as I mentioned, we're made up of 3 advisors and a tax lawyer. We're very rare that we have a tax lawyer on our team. Our tax lawyer spent about 10 years on Bay Street working at a couple of the big firms doing tax and estate planning, then shifted over to one of the big insurance companies and worked as their in-house tax and estate specialist, and then moved over to us where he's working just with us. So he's seen it all from a client perspective. He's dealt with clients on the legal side, he's dealt with clients on the insurance side, and his knowledge allows him to combine those 2 things and explain it to the individual clients and their accountants and lawyers. So he gets that in that room, and people understand, okay, well, this guy knows what he's talking about. He's smart, he's educated, he has the past. And that's why we want him, because he's amazing at what he does. With the rest of us as advisors, we're advisors, but we have a specialty across all levels. So from the family planning to the tax and estate planning to the business planning, as well as the certified financial planning, the life underwriting, all those different letters, while they just look like letters, what they do is they truly distinguish us as people and as advisors. It's the barrier to entry in the insurance business is too easy, unfortunately. We have a lot of people getting in, a lot of people who do it as second careers, even third careers, just side hustles. That's not what insurance is. You don't want the person who's going to be there to protect you and your family and your business to be doing this as a side hustle. You want people who are dedicated and committed to it. And that's what we believe we bring as a firm. And that's why we have those different designations to distinguish us there. As a firm, where we differ is the way we do our planning. Like I said, it's not box solutions. It's not you're 25 years old, non-smoker, you need this. You're 50 years old, high net worth, you need that. No, that's not how it works. Every single person, no matter what level of income, what age, what job you are, you're getting a true needs analysis. We're understanding your situation. We're understanding what's important to you, your goals, your future plans, and where insurance fits in. Once that needs analysis is done, the carrier analysis comes in. We don't belong to one carrier. We're independent brokers. We believe in doing the analysis across every carrier. Depending on the individual, the situation, a different carrier with a different product comes in, and that's what we will always show. And we'll show different options to explain that. Then it leads into the tax and estate planning. And while not everybody's in a position for tax and estate planning just yet, they will be at one point. So we believe in that full spectrum education, from explaining why it's important to think about to why it's important to eventually do, and giving that full picture to say, as I keep relating, we're not a box solution. We're not saying, get this insurance, goodbye. It's here's where planning comes into place. Here's where we handle that. Here's how we handle that. Here's how we would like to handle that with you.
No, I think you made a couple of really good points in that. The letters really tell people, the letters behind your name tell people that you've done the work and you've put the time and energy in. But the fact that you guys are specialized also says a lot about your dedication to keeping up with the industry, to ensuring that you can cover all the boxes. I think there is more complexity and things are changing all the time. Something that I personally look for is someone who is doing ongoing training and learning versus, has become a little bit complacent and is just using a cookie cutter approach. I've been through that process myself, and it almost seems too easy. Like there's got to be more to it at the end of the day. So I'm looking forward to hearing a little bit more about some of the typical issues that you're going to bring up.
Oh, yeah. So I think what we're here to really discuss today, that you and I have had these conversations in the past and wondered where it really fits into the individuals you're talking to, the accountants and lawyers who you speak with and their clients. And I think the biggest thing is the importance of having a shareholders agreement. When individuals go into business together, a lot of times it's on a handshake deal, which is totally normal, but then things start happening. Then money starts being made, families start occurring on the side. People realize that owning a business isn't as simple as shaking hands and saying we split everything 50-50, it's all good. That's not how life works, unfortunately, as I think we both know. So a shareholders agreement is a legal agreement that allows the business partners to contractually oblige to what happens in case of. In case of usually means death, disability, sale, divorce, retirement. And the shareholders agreement includes lots of different things, but it focuses on those different what happens if scenarios as well. One of the most common events being death. What happens upon death, disability, whatever that may be, if a business partner passes away, and where do those shares go? How does that get handled?
Right. So can you tell me a little bit more about when a shareholders agreement should be put in place? I mean, I founded a company, an excavating company, about 5 years ago with a couple of partners. When is the best time to put it in place? Should we wait a few years? Should we put it in place right out of the gate? Or what's your recommendation on that?
Ideally, you want to say day one, because A, that's when everyone's happiest with each other as partners. So there's going to be a lack of fighting. Furthermore, that's when everyone realizes planning needs to be done. So you may as well do it right from the get-go. And that's when you set things out. If you're waiting to do it for whatever reason, people wait all the time, say, well, let's make a little bit of money. Let's make sure we're sufficient. That's not the best way to do things, because that's when fighting could occur. That's when things are ready. There already may be one partner who feels they bring more to the business than another and want to cause issues there. You want to put this in place from day one. So the rules are set out, however they're set out, and you can then plan. That said, what we're going to talk about a little later on within the shareholders agreement, those things do change. So it's important to make sure they're updated, but you want to at least set the rules out in advance so there's no areas of concern. So furthermore, I think that leads to the question of, well, what problems can occur? So as we talked about death being the biggest issue, what if there is no agreement and death occurs? What happens there is the shares of the deceased pass through their estate to the spouse or children or beneficiary. This sounds like it makes sense. Yeah, great. My partner or kids, whoever, get to come in and get my shares, my 50% or whatever that percentage may be. But that's not always as easy, clear cut as you'd think it would be for many reasons. One, the family of the surviving shareholder may not like the family of the deceased shareholder may not like the surviving shareholder. That can cause issues where they don't want to be in business together. The family members may be incompetent and have now inherited shares of voting control of the company, but don't actually know what to do with it or how to handle it. The family may lack necessary funds to purchase the shares. Maybe they don't agree on the price of the shares and it causes issues. Maybe they don't even want the shares altogether. They just want money. They're said their partner is their life partner is no longer there. They don't want to work with that business partner. They just want out. Best case scenario, none of those things occur. That second generation comes in the business or the spouse comes in the business, but they don't really know what they're doing. It's very hard for them to just pick up where the last person left off without ever really being involved in it day to day to day to day. So I think a lot of issues occur. It's important to outline how to resolve those issues.
I think that's a good point, because I mean, I'm thinking about my particular situation in the excavating company. I don't run the day-to-day. One of our partners does run the day-to-day, and the other is in a different province, kind of helping out in the background. And if I'm just thinking of my partner in Alberta, something were to happen to him, his spouse would have no idea what the business is all about. We'd essentially inherit a new partner who may or may not understand the business and may want to exit. And I guess the question that we'd probably be asking ourselves is, you know, what's the value of the shares, and can we come to a reasonable agreement? And I can see how that can get a little bit sticky at the end of the day.
So now you've asked the question, how do we figure out the answer? The answer is a buy-sell clause. A buy-sell clause is a part of the shareholders agreement that's meant to provide liquidity to the surviving shareholder. As shown here, it ensures continuity of the business, it ensures a smooth transfer of ownership, and it provides greater certainty, not only to the shareholders, not only to their families, but to the stakeholders of the business, including all employees. And why that's really important is when one of the business partners passes away, obviously there's going to be a period of mourning. People are going to be upset, but then people are going to question and say, well, I was here because of that person. I really enjoyed working with that person. Is the business going to be around? Do I want to be around? When people see that the proper planning is done, they know that the business is handling themselves properly. And those questions, while can always still exist, at least the stress is alleviated, and those questions may not exist, and the speculation may not exist in the same respect as they once would have. So within the buy-sell clause, now that somebody's like, okay, great, I need a buy-sell clause, makes sense, what do I do? So the question is, okay, well, we need to fund it. We need to make sure that the proper funding is there so it works out as possible, as the right way. There's three options for doing so. Option one, which the smart business owner would think of, is to say, I want to borrow funds from the bank. I borrow funds from the bank to start my business. I borrowed funds from the bank to grow my business. Why wouldn't I borrow funds from the bank here? Totally understandable thought. Go, and I hope nobody has to try this, but go try going to the bank after one of your business partners passed away and saying, my business partner has passed away. I now need more money so I can buy them out. What the bank's going to do is the bank is then going to reevaluate everything. The bank is going to say, or whoever your lender is going to say, well, that partner who passed away was really the brains behind the operation. They were the ones who made things go. And even if they weren't the brains, maybe they were the wheels. Maybe they were the one who kept things rolling. In your situation, they were the ones who kept the operations going day to day, right? The bank may not want to loan you money if that's the case. Furthermore, while contracts are in place, we all know the banks can do things that the banks may start reevaluating what's already in place and say, well, maybe we want to make changes now to what's already in place because the way we structured it is no longer the case anymore. So while that seems like a smart idea, using somebody else's money, it's not the best situation here. So, okay, well, I can't use somebody else's money. Let me use my own money, right? And maybe you've got good retained earnings. Good businesses have good retained earnings usually. But to do this, you need to either use your personal cash or your corporate retained earnings cash, which requires after-tax capital to not only be invested in advance, but reserved for specific situations. Because if a partner passes away, you're not going to start liquidating all your retained earnings that you maybe needed to buy that next piece of equipment or to grow the business or do that next thing just to pay off the other person's spouse. So while liquidity is a great thing to have, it's not what you want to bank on for this, and it may not even be there at that time. So, okay, well, if I can't use somebody else's, if I can't use the bank's money, I can't use my own money, how do I get the money? That's where life insurance comes into the picture. Life insurance provides certainty and liquidity from the onset with no interruption to the business or the estate. The business would take, the policy would be taken out, the business would usually takes care of it. The proceeds are paid to the business tax-free. Tax-free is important because you always want to make sure things are done properly. And the way this works is the policies are acquired on the life of each shareholder, and I'll get into the different structures of how that happens in the next slide. But we would specify it specifically in the agreement to say, here's where insurance is meant to fund the buy-sell agreement. Here's how we structure it. That's how we take the policies out. When it comes to life insurance, which is this whole separate conversation itself, somebody may say, well, life insurance is really expensive. I don't want to use life insurance for this because I'm going to go into my business funds or corp or personal cash, and I'm not willing to do that. Just so you know, term insurance is what's normally done in these situations because it's the most cost-effective way of doing so. It provides total flexibility for future planning and allows things to be done as easy and as simply as possible.
Is the policy tax deductible through the operating company at the end of the day?
So this is always a question you want to discuss with your accountant. I'm not an accountant, so I'm not going to give tax advice. I'm going to say that within insurance, a lot of the time, especially with disability insurance, but with all insurance, when a person deducts it for tax purposes, it can then become a taxable benefit, which you don't want to happen. So you want to make sure you're talking to your accountant to get the proper advice on how to structure your policy to make sure that it is not taxable upon withdrawal.
Right. You don't want it to backfire at the end of the day.
Correct. So now that we've figured out the buy-sell clause needs to happen, using insurance is the best way to do so, there's 3 methods for doing so. There's the crisscross method, the promissory note method, and the corporate redemption method. The crisscross method is how things used to be done a long time ago. This method says that each shareholder purchases a policy on the other shareholder, hence the crisscross, and names themselves the beneficiary. Upon death, the surviving shareholder uses those proceeds, purchases the shares from the deceased estate. Seems to make sense, not the best situation. The reason why we don't often recommend this and why it's not the best situation is, number one, this situation tends to be personally held. You always want your policies to be corporately held when they're corporate policies. It makes it better for everybody, makes it cleaner. When taxes are involved, it makes it a lot simpler to figure out. So you want to make sure it's corporately held, not personally held. Furthermore, when you're doing it this way, the crisscross way, you're not actually equalizing the policies. Because, Jim, if you and I were partners, and you and I are similar in age, so it's not the best example, but let's just say I was 20 years older than you. And my policy would therefore be more expensive because I'm older. So you'd be paid more money for my policy when I'd be paying less money for your policy. That's not fair. Having it through the corporation covers the cost. While one may be more expensive, it equals out because the corporation is taking care of it. So premiums differ based on age, health. Furthermore, if there's several business partners, so in your situation, there's 3, how do you decide who gets who? Well, I get you, you get you, you get you, you get you. What if there's 5? What if there's 7? If there's bigger businesses, it becomes complicated. That's why we're not fans of the crisscross method.
Right. I was just going to say, I mean, if I'm holding the policy of the oldest shareholder and they've got, let's say, for lack of a better word, poor health and eating habits and this sort of thing, I may nudge them and say, listen, we need you to like sharpen up here because this is costing me a lot of money. So I can see how that would be a little bit dicey at the end of the day.
For sure. The next method is the prom note method, promissory note. The way this works, the corporation purchases the policy on each of the shareholders. The corporation is named the owner, the payer, and the beneficiary of the policies. While that happens, an agreement is drafted that requires surviving shareholders to purchase the shares of the deceased through the promissory note. So what that means is the agreement specifies the shareholders will purchase the shares for a promissory note instead of for cash. Upon death of the shareholders, the corporation receives the proceeds as they're the beneficiary, then pays them to the surviving shareholder of the respective holding company to satisfy that promissory note. Often this is the preferred method as it negates all inequities, cost variances we spoke about previously. It also allows for the deceased shareholders to use the capital gains exemption, and the surviving shareholders can then effectively bump their adjusted cost base of their shares up.
Is this the option that you would typically see if there are 2 or 3 partners, not a ton of shareholders, or yeah?
I would say this option and the next one are where we see more often. I think it's important when deciding is sitting down with your advisor as well as your accountant, your lawyer, getting a better understanding of how the business is structured and how the plans of the business are to be structured moving forward, as well as the individual's tax planning scenario. So we decide which makes sense to move forward with.
Gotcha.
So leading into the third and final method is the corporate redemption method. Similar to the last one, the corporation purchases a policy on each of the shareholders. The corporation is the owner, the payer, as well as the beneficiary. Upon death, the insurance proceeds then flow tax-free to the corporation. The corporation redeems their shares of the deceased shareholder with a deemed dividend resulting from the redemption. That deemed dividend resulting from the redemption can be paid through the capital dividend account. This method is usually the preferred method when the shareholders have used a portion or all of their capital gains exemption, as that's no longer, as we mentioned in the last situation, where it makes more sense there. That said, this method can be complicated as a stop loss rule may apply. And in this situation as well, the surviving shareholder will not get a step up in the basis of the adjusted cost base, as the shares are acquired as a result of a redemption. So it changes that. So again, to your earlier question, this is where the tax planning comes into play. This is where understanding a person's financial situation and the corporation's financial situation is important to understand to decide which of the promissory note or the corporate redemption method makes most sense for that individual and their business.
And I was just going to say, like in this particular method, what happens if the business is distressed and there's not a lot of money in the corporation? Is that going to create issues? I mean, you don't have any cash to issue a dividend.
Well, that's where the purpose of the insurance is. The funds come to the corporation and allow those funds to therefore be available.
Just to walk through the steps, if let's say one of my partners got abducted by an alien, and now there are only two of us remaining, the insurance would pay the corporation. The corporation would then say, okay, their 1/3 would now be owned by the corporation, which would really mean me and my partner now each own 50-50. The surviving spouse, let's say, would be paid through a dividend. Likely there'd be some tax implication on their side. So they may not get the full value of their shares because there's tax implication.
Again, this is the proceeds of the insurance flow tax through the corporation. So when they get from the corporation to the surviving shareholder, that depends on how it's structured and how the tax situation is, whether they've used their capital gains exemption, whether or not, and just making sure that everything's done properly so they get the actual proceeds as tax-free as possible. But it totally depends on the independent situations.
So it's complicated at the end of the day. I mean, it's not,
as long as you're working with the right advisor, it's not complicated. And that's why that goes back to the initial point, is you set this out in advance. If you didn't have this set out, that's where it gets very complicated, because as you've now seen, there's all different methods that can occur. So you want to make sure that it's being done properly so none of that does occur.
Right. How often would you see the crisscross method being used?
I've never seen it personally. I've heard about it. I know it used to exist. In the 10 years I've been in this business, I have yet to use it because I know that it doesn't make sense. But I'm sure 30 years ago it was there, and it's clearly still exists if it's still talked about. But yeah, it's not something you would really want to ever do. I think it's just if honestly the person either doesn't know better, or if maybe it's two people who are in business together where there's no actual corporation. So now that we've gone through all the different methods, we've realized that it's dependent on the person's situation, the corporate situation. It's really just, I think, goes back to the initial point in that when people go into business together, it's not always as rosy as you hope it's going to be. You want to make sure that this agreement's in place. So remember to draft that agreement that provides flexibility for changes in the business, flexibility where tax rules, whereby the corporation, the shareholder decide what method they can use and what method makes most sense for that situation. Again, be aware of the tax consequences that are associated with triggering the buy-sell clause, as like we said, they can occur in certain situations. But most importantly, just remember, a properly structured and funded buy-sell clause within a shareholders agreement allows for a seamless transition to the business after the death of that shareholder or disability. It also provides financial certainty and immediate liquidity for the heirs of the deceased shareholder. This is super important. Too often, we hear stories of families and business partners fighting because one person passed away, there's money that needs to be had, and nobody knows how to get that money in the best situation. When you get that check, while it doesn't bring the person back, and it never will, it alleviates that issue. It provides that certainty. Somebody says, okay, well, here's now I can do the next thing. My kids can go to university. I can pay off my mortgage. I can run the business the way I always want to run it, whatever it is, right? It provides that immediate liquidity. There's the lack of fighting, while it could always still occur, it alleviates a big chunk of it and makes people realize maybe they don't need to fight for it. Everybody's good. Everybody gets what's rightfully owed to them. Everybody can walk away hands clean and keep relationships well.
No, I think that makes a lot of sense. I mean, that's the last thing you want to be thinking about when there is a loss or a significant situation like that. I mean, the last thing you want to, be involved with is trying to sort all of this out. If it's spelled out in detail ahead of time, there's no back and forth. It's pretty cut and dry. How many businesses that you see would have this in place versus those that probably need to put it in place?
A good chunk for sure do. I think that there's obviously some that haven't. There's some where I've made them realize they need to do it. I think there's others where they think that their business doesn't need it because of what their business is, whether it's maybe the restaurant business or a medical practitioner company, that they think, oh, well, I've got my own stuff in place. No, that's not always the case. As soon as you have business partners, whether it's 2 or 20, you want to make sure there's protection. It's as simple as that. So I would say it comes up, even if the person doesn't have it at first, they at least know that they need to have it. So you always want to have that conversation at the least.
Gotcha. If people want to learn more about the services you provide and perhaps putting one of these plans in place, what's the best way for them to reach you?
Email, phone, both super easy. We're in a pandemic. We're in lockdown, so I'm around. I'm not going anywhere. But even still, I'm always on my phone. So it's always easy to get me one way or another. Even if people don't understand it or think they need it, but just have questions, whether it be those individuals, whether it be their advisors, reach out. As a firm, we're always happy to chat. We're always happy to review stuff. Even if an individual has one in place that they took out 10 years ago or 1 year ago, and they just want a second set of eyes, we always do that. We always do firm reviews where we're happy to take a look over it, see if there's any holes, see if there's any things. And if there isn't and everything's done perfectly, then we'll be the first to tell you that. So by all means, reach out. We're happy to just chat.
Starts with a conversation.
Exactly.
Great. Thanks, Samuel. Take care.
Jim, thank you so much. It was a pleasure.